We've been discussing the steps for auditing the purchasing process, and we've arrived at the final step, performing substantive procedures. Now that we know the risk and material misstatement, we can set detection risk by determining the amount, timing, and nature of the substantive procedures to be performed. Now that's important because as the risk and material misstatement increases, the auditor needs to decrease detection risk in order to keep audit risk at an acceptable level. And the way that the auditor can decrease detection risk is by increasing the amount of substantive procedures. Okay, so if there's a higher risk of material misstatement, the auditor is going to need to do more substantive procedures to compensate for that. Okay, now more substantive procedures is going to give the auditor a better chance of detecting any material misstatements. Now, what are the substantive procedures? Well, we're going to talk a lot about them. It's the subject of this entire video, so get ready. We've got two main buckets of substantive procedures. We've got analytical procedures, and then we've got tests of details. Now, you can further subdivide the tests of details into tests of transactions, like purchase transactions, cash disbursement transactions, and tests of account balances, okay? So tests of transactions, an example of a test of transaction would be vouching entries from the purchaser's journal. Maybe there's some entry that recorded a purchase transaction, and you vouch that back to the supporting documents, to the purchase order, the receiving report, and so forth to verify occurrence. Did a purchase transaction actually occur? So that'd be an example of a test of transactions, which is a test of details. A test of account balances, an example of that would be confirming accounts payable balances with vendors. Going to a vendor and saying, okay, is this actually your balance, right? Is this the actual correct accounts payable balance? Now, I'm first going to talk about analytical procedures, and then we'll come back and talk more about tests of details. So analytical procedures, what are we talking about here? Basically, with analytical procedures, the auditor is trying to examine relationships between different accounts and see if they make sense, if they're plausible. Okay. So some examples would be looking at financial information from prior periods and comparing it to financial information in the current period to see if there's a really huge discrepancy, comparing any financial information to budgeted information. Maybe something was budgeted at the beginning of the period, and then what actually happens during the period is way off, right? They had a lot more purchase transactions than what they had budgeted. And so you say, okay, flag goes up here. Doesn't necessarily mean there's fraud, but I want to look into it. Why was this big deviation between budget and actual information? Looking at relationships between different accounts. For example, if the company were to produce a lot of inventory, produce a lot more, just increase production significantly, or if they were to purchase a lot of inventory, they really just start stockpiling inventory, what would you expect? Well, if they're increasing production of inventory or they're buying a lot more inventory, you would expect accounts payable to also go up, right? Accounts payable should move along with the inventory count. If the inventory goes up significantly, generally you'd expect accounts payable to go up significantly if they're buying things on credit. Okay, so you look at that relationship between the inventory account and between the accounts payable account. You could also look at the industry average. For example, if we're thinking about something like days payable outstanding, okay, days payable outstanding, we could look at the industry average for days payable outstanding and compare it to the company we're auditing. Also, you could look at days payable outstanding from prior periods. If you see, okay, prior periods, days payable outstanding was 31, and then it was 32, 30, it was consistent, and then all of a sudden it's 57, and then that 57 is a lot higher than the industry average, it's higher than prior periods, then you're going to have questions. You're going to be wondering what's going on here. And so these are just some examples of analytical procedures. So with analytical procedures, the auditor is not looking at a specific transaction, right? They're calculating ratios from the numbers in the financial statements, and they're looking at differences between accounts and thinking about, okay, if inventory went up a whole heck of a lot, then accounts payable probably should have went up a whole heck of a lot as well. Now that we discussed analytical procedures, we'll move on and talk about tests of details specifically related to tests of transactions, purchase transactions, cash disbursement transactions, and so forth. So I've got a list of assertions here that management's making about transactions, and then I've got some tests that the auditors could do. For example, if you're testing occurrence, right? Management is asserting that the purchase transactions actually occurred. And what could the auditor do? They could inspect a sample of vouchers for the supporting documentation. Was there an authorized purchase order? Was there a receiving report? Was there an invoice, right? You're looking for that three-way match, that purchase order, receiving report, and an invoice as evidence of occurrence. Now, in terms of completeness, again, remember the danger is that maybe management maybe they understated the amount of purchase transactions because they wanted to understate their liabilities. So what they could do, the auditor could go and trace vouchers, right? Trace forward to see if those things were actually recorded in the purchaser's journal. Now, in terms of the authorization assertion, what the auditor could do is go to purchase requisitions, purchase orders, and actually inspect them and see if there is a signature there of authorized personnel. Okay, are people, for example, if there was a purchase order for $57,000, did somebody actually approve that? Right? Did that purchase order get approved? Now the auditor can go and take a look at the actual purchase order and look for a signature or initials. Okay? In terms of accuracy assertion, the auditor could go and recalculate the amounts that were owed to vendors, check the mathematical accuracy, make sure that there was the proper terms. Maybe they were supposed to get a 2% discount or something if they paid early. Okay. The cutoff assertion, again, with cutoff, the concern is that management might have postponed and said that some purchase transactions didn't occur till a future period, right? Just, let's say the year end is December 31st, and they want some of the stuff. They say, well, actually, these liabilities, because remember, purchase transaction is going to lead to a liability. So they say, well, actually that happened the first week of January. Actually, that happened January 4th, when in fact, it was December 31st. How would the auditor go about knowing if this was happening? Well, what the auditor could do is they could identify the reference number of the last receiving report. Remember, receiving reports should be pre-numbered. So look at the numbers of the last receiving report that was issued in the period. Okay, let's say it was number 597. That was the last receiving report in the period. Why does this matter? Why am I talking about receiving reports? Because when the companies receive the goods, that's when they're supposed to record a liability, right? So if the last receiving report was number 597, okay, then any receiving report, so 597 or lower, so like, for example, number 586. So if there was a receiving report number 586, there should be a liability associated. The company should have recorded a purchase transaction and then an associated liability according with the receiving report for number 586, because 597 was the last one. So let's say December 31st. So then 586 must have been before December 31st. So if they're saying, no, it didn't happen, we didn't receive the goods for number 586 till January 4th, then you would know, okay, management either made a mistake here or they're lying. So you identify the last receiving report issued in the period. Now, anything after 597, because that's the last receiving report, anything after that would be in the next fiscal period. Okay, so you identify that last receiving report. Anything before it should have been recorded in this period. Anything after that will be the next period. Okay. Now we'll do test of details about account balances. All right, so we did test of details for transactions. And now we'll do the tests related to account balances. So again, I've got it set up where I've got the assertions here for management. For example, management is making assertions about existence, that these liabilities actually exist. Again, generally, management would not be deliberately trying to overstate what their liabilities are. Usually it goes the other way. They want to understate them, in which case completeness is the assertion that we really care about. But again, there's a potential of employee fraud. Right? So this is, when we talk about existence, does this liability really exist? We want to know, is it actual liability of the company, or maybe one of the employees committed fraud? They set up a fake company or something, sent an invoice to their company. So what can we do? Well, we can review the voucher packets and again, look for that supporting documentation, purchase order, receiving report, and an invoice. Now, completeness, again, remember I said completeness, one of the, maybe the most important assertion that we're talking about here with the purchasing process, because then again, management has an incentive to understate the liabilities. They want to understate the liabilities. So the auditors wants to search for unrecorded liabilities. What could they do to try and find unrecorded liabilities? Well, remember I said that three-way match was very important. So they can look for a situation where there's not a three-way match. You can say, okay, what are situations where we have unmatched purchase order and unmatched receiving report? Those are the things that the auditor can do. The auditor can also, and this next one gets into the valuation assertion, the auditor can search for or send confirmations to the vendors to confirm the actual balance. Okay, so they can. This is similar to confirmations that would be sent with the accounts receivable process. Now, confirmations are generally more important for the auditor to do with receivables than they are with payables. Now, the reason for that is with payables, it's not as important for the auditor to do confirmations because the auditor they can look at vendor invoices, right? The vendors are sending a bill to the company saying you owe this money, and then there's going to be a monthly statement from the vendors. Okay, so confirmation is not as important with payables as it is with receivables. However, if the company doesn't have strong internal controls there are situations where it could be very important to be confirming the payable balances, right? So you'd reach out to the vendor and say, okay, it says here that the balance is $7,000. Is that in fact the balance? Or you might not tell them what the balance is and just ask them, just send them a blank form and say, okay, fill in the correct balance here. Yeah. Now, in terms of classification, what the concern of the auditor, they could go and look at the payables, for example, and see, okay, were they properly classified as short-term and long-term? Now, regarding, so we've covered the confirmations, we talked about this. What happens after we've done this? So we talked now about analytical procedures. We talked about the tested details. All this has been done. Let's say the auditor has done all that work. They've performed all the substantive procedures. Now what? Well, the auditor is going to calculate the aggregate misstatement for the accounts payable and any other related accounts that they looked at. If they looked at some expense accounts that were related to purchases, so let's just take accounts payable, for example, right? So accounts payable, it's a liability. They look at the aggregate misstatement, and then they compare that to the tolerable misstatement. Remember, if you're an auditor and you find that the account payable balance is off by $2, guess what? That's not material. That's not a big issue, right? So they say, well, what is the tolerable misstatement here? And then we look at the aggregate misstatement that the auditor has calculated as a result of their substantive procedures. So they do all these tests. They come up with what they think the misstatement is, and then they compare that to what's tolerable. Now, if the aggregate misstatement is higher than the tolerable misstatement, so if it's like, oh, well, the tolerable misstatement was $50,000, and the aggregate misstatement we think is $900,000. Okay, the auditor is going to want the client to make some adjusting journal entries here because the aggregate misstatement is exceeding the tolerable misstatement, in this case by a large margin. And so they're going to say you need to make some adjusting journal entries to correct this because otherwise we're going to say that the accounts payable balance has been materially misstated. Now, if the aggregate misstatement's less than or equal to the tolerable misstatement, okay, then the auditor says, accounts payable has been fairly presented. Now, we're still not done. We're still not done because the auditors typically at the end, they also have to go over some disclosures. Okay, that management might have made disclosures about long-term purchase agreements. Maybe they have a multi-year purchase agreement with a vendor, purchases from related party transactions. If the company is dependent on a single vendor, let's say they buy like 90% of their raw materials from a single vendor. So if the company has any of these kind of disclosures, then the auditor is going to complete their audit by going over these disclosures. And typically when the auditor is finishing up the purchasing process, they would go over a disclosure checklist and make sure they've got everything covered.